Awesome. So I guess we stand between you and reception. So we can, but thank you so much. I mean, the last panel, this is 2x the amount of participation I had expected at 3:30 on a Friday afternoon. So I'm really happy. So without taking much time, let me quickly introduce our three very esteemed panelists, and then, we jump straight into it. So starting with my left, I've got Shruti Rajagopalan, who is a senior research fellow at the Mercatus Center and a fellow of the School of Law at NYU. She's also an associate professor at the was an associate professor, at the Purchase College, SUNY, State University of New York. But what really brings Shruti onto this panel is she leads the Indian Political Economy Research Program and directs the Emergent Ventures India at Mercatus, which is basically a low overhead fellowship and a grant program that supports entrepreneurs and brilliant minds on highly scalable ideas in India. And the important part being, they really value meaningful contribution to society. She's a PhD from George Mason University and works more broadly on comparative and legal political systems. So I'm hoping to get some thoughts from her on this. Thank you, Shruti. And then online we have Ivan, who is a senior economist with the research division at the Fed in Chicago. And his work centers around the importance of banks and shadow banks, financing of SMEs and government entities. And he has a really cool paper which has received a lot of attention recently on ESG and financial markets in Texas. So he holds a PhD from the University of Rochester. And so Ivan, welcome. Thank you so much for taking the time to be with us. And last but not least, you're familiar with Sandeep already. I guess you must have heard him in the morning. So Sandeep is founder and managing partner of Green Frontier Capital, which is India's first green business accelerator fund, and focuses on supporting development of early stage companies in sustainable industries. And he's a very accomplished entrepreneur. He's also a professor at University of Massachusetts in Amherst, and he holds various board positions and has funded a lot of innovative green startups over the course of his 25 years as a venture capitalist. So Sandeep, thank you so much for being here. Great. So with that, let me jump straight into getting some thoughts. So two specific questions that I want to put to you guys. So we started living in this very interconnected global world. People moving, resources moving, climate change, AI, and that's going to transcend national boundaries. Even within a country, state boundaries, and so on and so forth. And then we talk about ESGs, right? And I am a complete novice, but I want to start off with, what does ESG mean to everyone? Because the more people I talk with, everybody has a very different perception and definition of it. So let me start off with, what does ESG mean to you? And how would you evaluate this landscape over the last few years and moving forward? So let me start with Shruti, and then we can move to other.
Thank you so much. Sorry. This works? Okay. Thank you so much for having me here. It's a pleasure, and thank you so much, Gaurav, for such a kind introduction. So at the face of it, it says environmental, social, and corporate governance, right? With these sorts of questions, it's always a question of who is doing the governing, right? So if it's a question of you run a regular business and you wish to govern it internally, and what I mean by that is employees have certain norms within a firm, right? The investors have certain norms. The founders have certain goals or a mission statement. To that extent, I'm sort of totally okay with whatever it might mean, right? Because it's highly specific to the people. The trouble is when these things turn into some sort of global framework and norm, which now every firm and every startup must start following, right? And then in typical style, all of this gets exported to developing countries where people are living in a very price sensitive world. And the most important thing is actually delivering what you need to deliver to your customers. But instead, there is an entire sort of circus or a machinery and infrastructure around signaling to other players who have virtually no skin in the game, right? So depending on which way you think about it, that's how I interpret the meaning. But personally, to me, all it means is innovation, right? There is a way of removing externalities. There is a way to get cleaner water. There is a way to get construction materials, that don't increase the PM 2.5 or PM 10. And what that really requires is putting your mind where you need to innovate. So I'm all for ESGs as long as that's your core business, right? If you want to be an ESG business, you should actually work in an area of clean water, clean air. If you want to work within, with social groups, that should actually be what you deliver. But being, I don't know, a pet clothing company and saying we're going to be environmentally sustainable by doing organic cotton pet clothing while our employees drink their drinks out of paper straws, like I just don't care for any of that. So that's my cynical view on this.
I run a climate fund, and so for me, the S and the G, while emphasized in the ESG acronym, because are difficult to measure, we tend to focus. We sort of talk about climate as being ESG. The reason being, it's easier to measure impact that climate actually generates. And there are very clear parameters that have been set for us by our limited partners, which make it easier for us to then drive investment decisions using an ESG lens, which is that any industry that we invest in must generate at least 50 gigatons of carbon sequestration or carbon savings by 2050. So the mandate is clearly sort of set out for us. And that's the basis on which we're actually able to drive capital. Now you asked another more relevant question, which is that how has ESG evolved? And are you, how do people kind of perceive what you're doing in the ESG space? And so, we have two major tailwinds in the geographies that we're actually investing in. Those geographies, that geography largely is the Indian subcontinent, but more importantly, India. And India, in order of magnitude, is the third largest emitter of greenhouse gas emissions in the world. It occupies a very small carbon space, but the fact of the matter is that the absolute amount of carbon emissions that actually come out of India are still fairly large, even though per capita they might be lower than the rest of the world. The interesting thing is that over the next 10 years or 20 years, India is the fastest growing economy in the world. And greenhouse gas emissions are directly correlated to industrialization. The more you industrialize, the more greenhouse gas emissions you're going to have. And therefore, the greater the opportunity to resolve the climate issue through that industrialization process. The US is driving the climate change narrative in the world. Unfortunately, the Chinese and the US are not seeing eye to eye. And that's the reason why India has emerged as a big beneficiary of US capital to drive the climate change narrative. Resultantly, India stands to benefit to the extent of roughly $100 billion each year for the next 10 years. Therefore, the long-winded answer to a short question is that the interest for us has been increasing tremendously. But the precondition, however, remains that we have to provide our investors with measurable metrics of the companies that we invest in so that we're not accused of investing in greenwashing kind of opportunities. So hopefully that answers your question.
Yeah, thanks. Ivan?
So I don't think I can add that much more to what was already said. But I think in terms of from the academic point of view, from the financial markets point of view, it does look like ESG principles have been adopted more and more widely recently. And this can all be traced back to the early 2000s, like with this pledge in the UN, right? And that has started the whole thing. But one one key fact here. So there's lots of academic work on this, obviously, in the past 5 or 6 years, and some of it shows that ESG adoption could be useful to the companies who like adopt it in a way that it could hedge like risks for these companies. So I know that's overly broad, and I think these studies, like some of these studies, have been just purely theoretical, but that may be like some things to think about here. And in terms of the financial, like have adopted it. I mean, in my study, we look at like the largest banks are the ones like in our study that tend to like adopt these. And I think if you read the financial press, the same could be said for the largest other financial institutions, whether that's like investment funds and so on, or like other types. Yeah, so that's the only thing I can
Yeah,
understand.
so Ivan, let me follow up on some of the recent work that you've done to ask you on, you work at the Fed, and central banks across. So we hear a lot about ESG when it comes to fiscal policy, right, and how governments and businesses in the private sector should respond to it. I wanted to get your thoughts on more on the monetary policy side. Like, you talk about private banks and lending from the banks itself, but from a monetary policy standpoint, from central bank standpoints, for example, um, is there a concept of sustainable bank lending, or are there monetary policy interventions that one could consider? That's one part. And the second part I wanted to also get your thoughts on is, are there differences that you might see between advanced economies like the US or the Fed deciding this versus emerging markets like India and the Reserve Bank, for example? Like, are there any key differences that one could think about between these scenarios?
All right. Thank you for the question. I just wanted to say real quick and that the views expressed here are just my own. Those are not the views of the Fed, and I cannot really comment on monetary policy. So in terms of the bank lending side that you raised, so this is something that like other like studies have like explored, right? And I think the like academic work, I think it has grown quite a bit, like I said earlier, like in this space. And what the studies find is that these like results are mixed. So some studies find evidence for like cheap talk, right? So these institutions say that they're going to do what like basically like conform with such principles, but these studies find evidence that they don't really. And some studies find like effects. So it's really unclear like at this point, right? I mean, I think the issue from my point of view, from the data side, is that these principles like haven't been around for too long, so it can't really tell very well, like what the effect is like yet, right? In a way, the dust needs to settle first, right? When you write an empirical paper and when you look at the data, I think you need to kind of like be able to like test empirically whether that's the case. So I think I'm sorry, it is not satisfying, but I think it's kind of hard to tell. So just to point you to my paper with Dan Garrett. So yeah, so I think what we look at there is basically the anti-ESG law that Texas enacted in September 2021. What we find is that following the adoption of the law, the cost to state entities and to local governments, school districts, special districts, and so on has increased. For those that used to work banks that were barred from the state. So one thing that's important for the findings, how to interpret these findings. I mean, the costs that we find are not very large. They're significant, but they're not huge. And one like important point about them is that Texas is one of the largest public finance markets in the United States. So there is substantial competition like in that market. And I think we've been asked like many times to like extrapolate how this would apply to other states or to like emerging market economies like outside of the United States, and that's really tough to do, right? Because you have so much competition in the state. You also have like you have over 50 or 60 active banks in this market, and when like five leave, we find that that does have an impact, but it's not a huge impact since there's other types of institutions who can enter the space. So like one thing I would say here is that you need to weigh like what the competition like in the market is, and like forces like that to be able to tell, and what other tools market participants have to like offset such a cost. And so it's very hard to tell though, like without another study, like detailed study, I think it's almost like impossible to tell. But yeah. And I think one thing that I would also mention here is that the laws in Texas, as we show in our paper, they were based on two key sectors, the oil and gas sector and the firearms sectors. And like obviously, I think the work that we cited in our study kind of like emphasizes that these sectors are very like important for the state. But I think in other markets, what one would have to take into account is how important these sectors are, right? And so yeah, so these two things at the very least, and there's many other factors, right? And like again, I would emphasize that the financial markets in this country are, the most developed. So I think in other settings, the impact may differ, since the market, there are not as many options out there that market players can use.
Yeah, so in India, ESG considerations are not taken into account when banks do lending. But India has a very unique response to that. And why I say the banks don't usually have ESG considerations is the demographic where the ESG aspect actually matters the most is in the financially excluded communities where there is no credit history. So in India, the response to that has been through a very interesting mechanism called the non-banking finance companies, NBFCs. And we've invested in a number of these NBFCs that actually raise equity capital and then go to a multilateral agency like the World Bank by providing the fact that they're actually lending to the financially excluded communities to lever up their equity positions by 4 or 5 times, thereby bringing down their cost of capital. So social entrepreneurship in India is actually happening at the lowest level, where people are actually moving from villages and coming to cities. And historically, what used to happen is that they used to actually, the mode of migrating from villages to cities used to actually happen through the factory model. So you were a farmer, you were a farmer's kid, you basically came into the major city, you actually worked in a factory, and then you had a family. The family basically had, the kids would study in the city and then find themselves a better job rather than growing up in a village. What has happened is that digitalization and decarbonization have actually completely eliminated the brown frontier and have created green frontier opportunities, which was essentially the inspiration behind why we called ourselves Green Frontier Capital, which is that you completely eliminated an entire step in the migration process. And the reason why you've been able to do that is the presence of non-banking finance companies that are allowing for large-scale funding to actually happen to financially excluded communities through NBFC. So India has a very, very unique response to that problem.
And Sandeep, just to also get your thoughts on, apart from the South Asian region also, if you look at other regions of the world, for example, what is your take on some of their, both opportunities as well as challenges that are being faced, as well as what you think?
From an ESG perspective?
From an ESG perspective.
In order for, so I'll actually talk about the startup sectors that I'm actually investing in the United States, for example. I'm also looking at stuff in Europe, and these are not necessarily emerging markets. So I'm trying to kind of focus on the theme of the conference, which is emerging markets. The issue has always been one where the largest incumbents in each of these emerging markets are companies that don't engage in ESG practices. So in order for you to actually get finance available to actually engage in ESG practices, you're actually going to have to drive that finance from the larger corporates who don't want to do that because you're effectively, kind of questioning their own existence. Today, one of the largest providers of, ESG funding, for example, is Saudi Aramco. But is Saudi Aramco actually going to go out and provide enough capital for ESG initiatives so that they actually then displace their own petrochemical and refining business? I don't know, that question sort of remains. So I think we'll have to see whether ESG eventually displaces existing businesses or not. But right now, I think ESG is more part of CSR initiatives than really a major spend by any of the large incumbents.
Got it. So this mic may have died.
Okay,
but-
you can use this.
You could use this. Thank you. Yeah, thank you.
So Shruti, I mean, I wanted to. So you have. It's working. It's working. Thank you. So Shruti, I wanted to get your thoughts on. So finance is one side of it. The other, I think, big piece, at least in my head, is when you form policy around this, or when you think about the private sector or the public sector operating within certain frameworks, right, that are designed by certain stakeholders, and you have a great Substack on the pollution in Delhi, right, and how this is across states that you need coordination, and you can scale it up to think about across countries.
Yeah.
You need cooperation. So I just wanted to get your thoughts on. Well, we've understood a little bit about finance, but what about the other frameworks, the design, the stakeholders, and what is your take on that?
Honestly, between the finance part and the policy part, I know they feel like completely different worlds, but at the core of it, the problem is the same, right? When we were all in grad school, we were taught, or at least, in undergrad, we were taught that the only job of a central bank is keeping inflation under check, right? By the time I got to grad school, it was inflation and unemployment, right? Now, when we're teaching this stuff, it's inflation, unemployment, and climate change, and all sorts of other things. So, it's a little bit, the reason I mentioned that is, again, at the core of it, as economists, we're trained to optimize. What are we optimizing for? And when push comes to shove, what are you trading off and what will you prioritize? This is really important, right? And Sandeep already said, there's a whole bunch of stuff here. We prioritize the E, and even within E, we prioritize climate change and carbon offsets, right? And he also mentioned why, because it's possible to measure impact. You can actually move capital towards it and so on. I think this is the problem in all policy. So now all of us are in the United States. They passed the Inflation Reduction Act, right? Now think about something like solar panels, right? There is a fight between the E and the S and C in some sense, which is, on the one hand, they want protectionism such that the solar panels are actually made in the United States. They employ more American workers because American worker standards are better, it's more inclusive, and yada, yada, yada. On the other hand, if you actually just imported cheap Chinese solar panels, you would have more solar panels at cheaper cost and more people could use renewable energy, right? Now you're all smiling, but this is not a one-off thing and that Congress got wrong. This is at the core of every single policy decision, right? And this is where all of you need to be really thoughtful, whether you're doing policy within corporate governance for your own firm or in a broader sense at multilaterals or, God forbid, at a global level. We really shouldn't touch that, right? Some of Gaurav's work has looked at this, right? Which is looking at employment in the informal sector. Now you start exporting these best practices. Sorry, I've forgotten the names of your co-authors, but you can mention them. In this paper, it's really lovely. He's looking at how we want better standards for employees, right? We want everyone to be in the formal sector. We want them to enjoy all the basic things that we think are important, which the formal sector does provide. Now, the more of these regulations that you start tagging on and the more of these best practices you start tagging on in the formal sector, guess what happens? It becomes too costly to do business in a country like India. And actually, a semi-formal sector company decides to move completely to an informal sector, right? That's sort of like the core trade-off that's being made. So this is an example of how these things are really difficult. And don't drink the Kool-Aid of, if it's ESG, it is so obvious that it is good. Because the question is compared to what, right? And even within E, S, and G, what is it that is the best of the three that you're really gunning for if push comes to shove? And push will come to shove because you all have to be in profit maximizing businesses, presumably, right? So I think this is the core. One last thing, on the Indian example, you spoke about, the subset within E, which is climate. I think climate is a very developed country problem. It's a first world problem. The developing country version of that is pollution, right? They care really about their local environment, which is clean air, clean water, clean surroundings, garbage disposal works, and so on. And here, I'll tell you both the good news and the bad news from my work in India. So I had this paper with my co-author, Alex Tabrock, who's one of my colleagues at George Mason, and we looked at how so much of the public goods framework in India is broken that actually private people supply those services. So if I can just get you guys to raise your hand on how many of you grew up in a developing country setting. Okay, perfect. Enough of you, right? So you have a sense of how many really poor people actually use their income to buy clean water, right? Or have to have an air purifier because their kid keeps getting sick and can't, attend school. Or they pay for garbage disposal because otherwise literally outside their home, there's like a pile of garbage. So these are things that are provided privately, even in slums, they're provided privately in all these urban settings. A large part of the disposable income goes towards this, which for all of you in a business school means opportunity, right? So how can you deliver services which are standard public goods provisioning and externality elimination, which in developed country settings, we completely assume that the government will do that. But in developing country settings, we know the government doesn't do that, right? So the paper we wrote was actually a case study where we called Gurgaon a private city because everything, including law and order and fire services, was provided by private companies. So this is the good news, that you can actually have ESG companies which deliver the good, not just make something else and then say, oh, we're going to offset some of the damage we do in the world. You can actually make things better by delivering directly to the consumer. And then the benefit of that is you eliminate some of these other trade-offs, right? Am I going to serve my consumer, or am I going to actually serve this other greater concern that, one of my donors has or a multilateral agency has, and so on. So that's the direction in which I would nudge the entrepreneurs in this room.
Thank you. So I promise I'll leave time for questions, but I want to get one more round of thoughts from and especially two of you. Ivan, one quick question for you, which is on, again, since we're talking about emerging markets here, I want to get your thoughts on how does one think about lending ESG to emerging markets, right? From a very macroeconomic perspective. I understand it's very complicated. It's almost impossible, as you say, in terms of thinking about some of these things. But is there hope? Like, what is if I were to tell you, like, if there was one policy or one monetary macroeconomic policy you wanted to really push in emerging markets through the ESG lens, what would that be for you? Or is that an impossible question to ask?
I don't think I can comment on that, right? Like on the formation of the policy itself. So I cannot comment on that. But I think what I can maybe like think about is, the largest institutions, they're like exposed to both the United States and like emerging markets around the world. So I think one thing that could be like really like cool to think about is like to what extent these institutions are like exposed to like sectors that fit or don't fit with these ESG principles like around the world, and how like maybe if such an institution is to like adhere to these principles, how it's going to affect lending to one set of firms, say in the US relative to like firms in other markets. I think that's important to like think about, right? Because I think there could be loss of like capital to certain firms, right? Like whether it's here in the US or somewhere else, and some firms could gain, right? Like because there's so much capital that the bank has. But again, this is like highly theoretical, right? Right? Because I think like you would have to know, like, to what extent the bank is exposed to each of these markets and which markets they're going to prioritize. As some of my fellow panelists said earlier, like, what are these goals that the bank is trying to like achieve? Like, I think like without like knowing more about that, I think it's really hard. I mean, it's very complicated to like think about this all at once, like how like it's going to move. And then I mean, like we show in our paper, we have all these local players, like smaller banks that are more like local or regional, that may not have the same set of incentives, like as the large banks, right? So I think that's something to really keep in mind here.
Thanks. Sorry.
Oh, sorry.
For me, it has to. Sorry.
I can't hear you
Oh.
if you don't use a mic.
Okay. Sorry.
This works?
Yeah.
Oh, yeah.
For me, it's the first loss lending guarantee that if you must have seen, the biggest focus of COP was all these developed nations actually coming together, creating a common pool and providing a first loss guarantee mechanism for loans to be made to developing countries. Because, for example, the countries that need the loans today are the ones that are in the worst position to service those loans. If you remember, climate change affected Pakistan during the flash floods about 2 years ago, where the country lost about $30 billion. Pakistan's already a country which can't service its debt, but it needs funding to solve climate change more than any of its neighbors in the region, maybe keeping aside Sri Lanka, for example. The question is, who's going to lend to Pakistan? So the developed nations all have to come together, create a common pool, say, all right, we're going to basically lend to Pakistan. And if there is a first loss, we'll actually share it equally amongst ourselves. So the more you want to solve climate change, greater collaboration and first loss guarantee mechanisms are very, very important.
So you're both investors. So one question I have is, what recent investment or what business have you recently invested in that you are both really excited about, and why did you choose to invest in that business?
So there's a slight difference between us in the
Yes.
sense that, Emergent Ventures doesn't take an equity stake. It's a single unconditional grant given at a very, very early stage, sort of like, seed or pre-seed. And our goal is typically what we see is in these developing country contexts, everyone just wants to invest in SaaS. First of all, I mean, maybe you guys can solve this for me. I don't understand this obsession, but it's like, what's the next DoorDash for India? Like, who cares, right? So anyway, so that's where everything is going. And that's where everyone's willing to put money in. And it's another kind of elite imitation of what's happening in Silicon Valley. But what actually Indian consumers want is a better air purifier, is how to get clean water, is how to make sure that, whatever their little Vespa that they are riding or the bicycle they're riding can turn into an electric bicycle. Will it have a battery attached for long distance because we don't have a good charging infrastructure? So these are the questions they're battling with. So that's the sort of stuff we like to invest in because frankly, no one else cares to invest in that. And our goal is sort of to get these people up to, MVP, and hopefully then the market will chip in the money. So very exciting thing that we invested in a couple of years ago. It's a firm called Pran, which literally means life. And this was a hyper-local air purification solution, which is not just indoors, though it works indoors, but it also works outdoors in a hyper-local setting. And this really bright, young, genius engineer from Georgia Tech, his name is Angad Daryani. He did like internships at Tesla and all these people you're shaking your head, Angad. And he came to us and basically he had a fantastic prototype and no one was willing to invest in him. So we sort of, got him the money to get him up to a point where he could get a product that could be pilot tested, because that's the data on which you can then raise money from the next set of people, and then eventually people like Sandeep will come in and put their weight behind it. And it's done phenomenally well. Like he's managed to raise like multiple rounds of funding, and right now I know people who've had this installed in slum schools in New Delhi, where from 400 AQI it's come down to like 25 AQI. And this is a really big deal because the poorest children actually are, I know it's a public bad and technically it's supposed to land on everyone equally, but actually we know that it doesn't, right? People in poorer households and children from poorer households actually experience the worst form. A grant I approved yesterday, which I found very exciting, is did you know that solar panels can catch fire? And this is actually not a non-trivial problem. And so there's a very interesting company which is working on both a way to prevent the fire and also devices to monitor. And again, the same problem. No one will give them money, though they're an up and running business on something else, which is, the glass paneling on solar panels. They have great clients, they have a revenue stream, but no one will invest in this. So we are the people backing the sort of development cost of this to get them up to a stage where eventually others will invest. So this is the sort of thing that really excites me. I can give you about 40 more examples in Q&A,
Yeah.
but I'll stop. That company was called RenQ, the second one.
This is a question that's going to get me into trouble because I've got 14 companies in my portfolio. And given that this is being recorded, if I mention one or two, the other 12 are going to turn around and say, why didn't you take our name? But I'm actually going to speak about these two companies because I find that they actually showcase innovation that's taking place in India and really exciting stuff, right? So one of the biggest issues for climate change is methane. And as you know, cattle have a big reason for methane gas emissions. So there has been a move to look for milk alternatives. And we invested in a very interesting company in India called Zero Cow Factory. And what Zero Cow Factory is the founders, are bio technologists. They took a biopsy from the cow, and inside the blood sample that they got, they basically took out the genetic DNA milk making sequence, and no cow was killed in the process. And they took that sequence and they basically superimposed it upon a microbe to basically trick the microbe into thinking that it was a cow. And then that microbe was actually put into a bioreactor and fed the same nutrition that a cow would effectively get, so that milk could get produced in huge bioreactors. Now, therefore, it's, you're now making lab-based milk. It tastes like milk. You can actually create an entire industry of byproducts of milk, which you can't do with plant-based milk. Plant-based milk, the problem with plant-based milk is it's an acquired taste, it's expensive, it still has climate issues, and you can't make multiple products out of it. I mean, you can't make butter, you can't make cheese out of a lot of plant-based So Zero Cow Factory was very unique in that it's actually created that at a lab scale, and now they're going to commercialize it. And soon you'll actually see multinational companies in India using the API equivalent, which is the powder that the company makes, which is then going to license out to the multinational corporation, who will then add water in its own premises to create milk and then use it to basically manufacture a host of other products. So it's incredible. And they did it with A2 protein, which is a typical protein sequence that is available largely in India and associated with the local cows there. So that was one company. Another company that we invested in, which is very cool, is it's called NutriFresh, and it's a controlled environment agriculture company. And the reason why I bring up these food companies is, interestingly, India, the entire energy transition situation is a very politically sensitive situation. But when you have 1.4 billion people in your country, the tailwinds that come from minor changes in consumption activity can have an equal impact on the environment, so you don't have to actually pay to energy transition. 45% of India's greenhouse gas emissions actually come from what we eat, how we grow it, and how we travel. So why play green hydrogen? Why try and figure out the next substitute for gas? People can make small lifestyle choices that are different. So NutriFresh is actually very interesting. The entire retail market in India is an $800 billion market. It's growing at 8% each year, in line with GDP. But e-commerce as a percentage of total organized retail in India is less than 1%. It's about 1%. People in India don't buy fruits and vegetables off curbside anymore. They actually go to organized retail and buy fruits and vegetables like we do in the United States at Whole Foods, etc. Why? Because people want a high quality product when they want it. We have been used to a country where if you wanted to eat mango, you can only do it in summer. I know actually Indians who travel from the United States and go to India during the summer season because that's the only time when they can eat actually a mango.
Yeah.
And I've tried to figure out how is it that Americans sit here in the snow and eat mangoes in December. And we don't eat, and we are one of the largest mango growing countries in the world, and we can't eat mangoes anywhere other than summer. Similarly, we can only eat strawberries from November to February. If you go to India post-February, between February and November, you can't eat strawberries in India. So it's shocking, right? So there is a solution to that. The solution is basically control environment agriculture. So hydroponics is a very, very big area. It's soilless farming, uses 90% less water, and it's as simple as actually buying an acre of land, putting up a polycycle sort of a facility there, exposing it to the sun, and growing fruits and vegetables. So, and that basically becomes the provider of large-scale, consistent quality, non-seasonal fruits and vegetables to organized retail. So those are two companies we've invested in, and we feel that they're going to be absolutely, category leaders and will generate a lot of returns for investors.
If I can add to that, I think more than individual firms, we've given about 3 or 4 grants to high school students who are working on biomimicry. And biomimicry is exactly what you were talking about. Except in this case, it was things like how can we get biomimicry of plastic? Because then it'll be degradable, right? Then you don't have to suck on paper straws just to signal some kind of virtue or ESG or whatever. And you can, actually get a biomimicry produced plastic-ish straw that will then be degradable and so on. And this actually, these grants are like a few $1,000s. I'm not saying they're going to change the world or operate at the scale that he was talking about, but that would be the start to then the next thing and the next thing and the next thing. So I would also really pay attention to biomimicry and what's happening in labs, what's happening to food technology within the labs, not just to food technology outside the labs.
One additional point.
Yeah.
I'm just going to ask a very interesting question to make this really interactive. Innovation still happens in the global north. We're talking about these great ideas coming out of India and other parts of Asia, but I saw a very interesting picture the other day on LinkedIn. Why is it that Google, Microsoft, Meta, they're all American organizations? Why is it that the US produces the most innovative companies in the world, and India and some of the other countries, basically we engage in price-led innovation or applied innovation, but fundamental technological innovation only happens, and it happens largely in the US. It doesn't even happen in Europe. Google is not a German company. Tesla is not a British company. It's all in the US. So the question I always ask is, why is it that innovation still takes place largely in the US? And I wanted to bring this up, and I wanted to ask this question, so thank this platform. So anyone wants to take a guess on why that happens? Yeah?
So before coming to Darden, I was running my health tech startup that detected skin diseases using AI and images. And we were very early in the journey. We started in 2016, and it almost took 4 to 5 years to just get permission to collect images ethically, because pre-pandemic, telemedicine was also a sin in the country. You could be jailed for that. So the pipeline, the red tapeism is so much, it almost becomes impossible. And even if someone takes a chance on you, they want that returns to be very immediate. So if you're looking for poor people's disease, like skin diseases, and you're not going to get that investor who has that whole field.
So understood. So you're saying that the culture here allows for longer duration returns rather than immediate returns. Okay, that's one. Yeah.
I think it has to do with the fact that whether it's intended or not, there is in effect a social safety net in the United States. So that if you fail, you're okay, you can get back up and do it again. Whereas in other countries, you fail, you're down and out.
You got it. That's exactly right. So in the US, failure is celebrated. And if you're a venture capitalist, which I am, when a company comes out here to in the US to meet me, the first question that typically gets asked is, what's your background? Have you done any companies before? If you failed, it's actually a good sign because you've learned something. And in India, for example, if you fail, you're done. You're not going to get a second lease at life. You're going to end up, working for a salaried, position for the rest of your life. That's changing. But the culture has not completely gravitated to one where failure is easily accepting. Therefore, my point still remains that if you really have to invest in India, the returns are going to come from scale, and they're not going to actually come from fundamental and technological innovation. So, I was trying to answer and add to the point that you were trying to make here.
I actually have the exact opposite answer that you have, and I'll tell you why. India is really poor at scale, right? I'm not talking about the e-commerce sort of platforms which have sort of circumvented the problem. They pretend to have scale, but we know that there's a very tiny, pool of customers within 1.4 billion that they can actually make money off of. I would actually say look to India for weird hardware-driven innovations, for innovations in areas that you don't see in the developed world because they live in a context where there are clean streets and there is clean water and there is clean air and someone will pick up your garbage and all of those things. So in India, the first thing you see a different kind of entrepreneurship. Now, where we both agree is that when you need a certain level of scale of innovation, America has the capital and America has the ability to absorb the shock or the failure, that may come from it. But in India, the reason that doesn't happen is twofold. One, the GDP per capita of the United States is, 64,000. India is 2,200, right? So even among the richest, most elite Indians, some of whom are here in this room, you are basically like that tiny top, 1%, maybe 1 to 5% if you're here on a scholarship, right? Thereabouts. So I think that's one reason you can't scale in India. You just don't have enough customers who can afford to care about the sort of thing you want them to pay for. So if you see, India is the largest number of eyeballs on YouTube, but that's because it's a low opportunity cost country with high levels of unemployment and very cheap, 5G or 4G or whatever it is, right? The United States simply can't match that scale. But you start asking Indians to pay for YouTube, now you're in very big trouble. You're going to see those eyeballs, disappear overnight onto whatever is the next thing that's sort of free and not for subscription. So that's one thing. And the second is, on the bigger question of why the US innovates, I'll just point you less towards the safety net issue, because it's not like most European countries are innovating. And they tend to have pretty substantial, the Scandinavian Novo Nordisk and stuff like that, set apart. So you get a few examples. I think I will just point to Paul Romer and endogenous growth theory. Even in the United States, you don't get it everywhere. You get the innovation in some very specific pockets. You get it in Silicon Valley, you get it in New York, now increasingly in Texas and so on. Maybe for industrial manufacturing heavy products, you get it in the Midwest. And that's about it, right? We're talking about a few thousand square miles in a very, very large country. So I think the endogenous growth theory is, I would hang my hat on that. It's not yet gone away.
Always lovely when the moderator can sit and just listen to these things that the panelists are going on, which is amazing. That's the ideal moderator job. But let me open it up for questions now.
Well, first
can you just introduce yourself in one?
Yeah, Max Rappaport, first year at Darden. I was also going to say, I wonder if it has to do with the place where these countries are in terms of the smile curve and the value chain, where I think we've seen with China as well. They've had innovation, but it's more in terms of modular manufacturing, right, versus R&D. My question is actually to Shruti about sort of your view on the role of ESG for a private firm. I think a lot of first years might smile at that because we've taken first year ethics, and actually Darden is known for a theory called stakeholder theory, which sort of flips on its head the idea that a private firm is solely responsible for shareholder returns, and has to consider other aspects such as negative externalities and the employees and the people that are affected in terms of the products. So I'm curious, sort of, if you can elaborate on your views about that, if I'm capturing them correctly, and whether you think it's related to sort of market-driven forces, whether if shareholders were, I guess, more desiring of ESG returns, whether your views would change, or whether it's more just from like an output perspective, if like you view private firms as maximizing output.
So, on your first question, I think it does matter where you are in the growth cycle, right? So in 1960, South Korea was where, Yemen and Syria are today. It was devastated by civil war. It was like probably the third poorest country in the world or something like that. Before they liberalized, or just after they liberalized, their early exports were human hair, right? That was the best thing they could export cheaply at that time, human hair. And today, pretty much everything that runs in your dorms and in this room, right? Every television, every washing machine we use, everything comes from Korea. And between the human hair and how they did this, initially it was all reverse engineering, right? They would literally get laptops from the West, they would pick them apart and say, how can we put this together cheaper? And then eventually, there's both learning by doing, and then South Korea also increased the amount of R&D as part of its GDP per capita. So I think now it's over 3% or something. It's pretty high, right? So now they make better sunscreen than the United States because, I don't know, FDA, something. So leaving that aside, coming to your second question, I like ethics classes that impose a scarcity constraint. And this might be a quibble because I'm an economist and don't do like mental models. So if it's an ethics class that gives you a trolley problem where shareholders are actually, tied to different parts of the trolley and then asked to choose when push comes to shove, I'm willing to go with that, right? The reason I mention that is in the real world, the day before the shareholder meeting, or if you are, public the day before your investor call and what's going to happen to everyone's comp and bonuses within your firm, which is the S of the ESG, right? Partially, you are going to care about this. You are going to care about your profits. So should you have nothing to do with the environment? That's not what I'm saying. I mean, you should obviously not be fraudulent. You should follow regulatory norms. You shouldn't break them. Ideally, you wouldn't bribe people to get around those norms. And, so basically above board practices is what I would expect. But beyond that, it's not that I'm saying they shouldn't have these priorities. I'm saying they can't have these priorities. And I think that's an important distinction. We can have these priorities in a classroom. We can have these priorities when you're a multilateral lending institution that has already absorbed the loss of a loan that will definitely go bad. You can't be a fintech company talking about lending to ESG sectors and say, I'm willing to absorb a loan that goes bad. Then you shouldn't be in lending. The number one rule of lending is that you make money off of it. If you don't, you're a bad lender, you should get booted out of the market. So that, I think, is the distinction. So if you guys are interested in that, work in a philanthropic firm. That's what I do. Mine is not an investment for equity. It is a philanthropic grants agency. I write a check, forget about it. Most of them expect to be failures because it's a moonshot grants program. So work at philanthropies, work at multilateral organizations. My problem is when we start pushing and nudging what should be profit-making companies into saying, hey, you really shouldn't be prioritizing your profit over other things, right? And cost cut somewhere else so that we can have 15 inclusivity celebration days or have paper straws served in our cafeteria or whatever else is the latest marketing gimmick. So the reason they become marketing gimmicks is precisely because they can't do it. So having this expectation that it can be done, I think is where my problem is. Now, if it can be done, great. If it's part of the mission, if the original investors are willing to take a hit, if there are people, firms like Ben and Jerry's where they say that the leadership should not be paid that much more then the janitor, knock yourself out. But you have to deliver to your customers and you have to deliver to your investors. And only after that can we even think about starting to deliver to our employees and our neighbors and our community, and then resolve every other problem in the world. Because we live in a world with scarce resources that need to go to their highest valued use. So if there is an ethic I have as an economist, that's the only one, right?
That's interesting that she's saying that, because I actually read a research report which said that companies that engage in ESG practices actually outperform those companies that don't. It was written by a research.
Then that's great.
But yeah, I'm just saying that, like, the ultimate price discovery mechanism today is the stock market. And if you engage in, ESG practices, you will get a premium. And I think the name of there's something called the carbon report. You can actually print it out off the web, where the academics have actually studied the outperformance of ESG friendly companies of those that didn't, and there was on a risk adjusted basis a clear outperformance of the same. But I see what you're saying.
And honestly, if that is the case, I'm all for it. And my hunch would be the reason there are two possibilities why that's happening. One, because firms that are better at innovating are probably better at ESG to start with, because they're really good firms that innovate well, and therefore they can deliver on this. The other is we have completely mislabeled ESG companies, and that's where the distortion is coming from. And I think we know examples of both. Right? There are companies that just market themselves as ESG, but actually don't do very much and still perform very well. And then there are companies that are actually very, very high end on innovation, which are great on this. So I think a distinction.
Or there could be a spurious correlation.
Exactly.
That's the third possibility.
That's a third possibility, but let's assume there isn't and that report is legit. I would say then go for it. That's fantastic. If you can save the world and also deliver to the core people you are supposed to deliver to and optimize scarce resources, you've hit jackpot.
Yeah.
Right? If not, you all will be forced to make difficult choices wherever you work. And at that point, I think you will have to let go of some of this, the marketing stuff.
Any other questions? We probably have time for one. Rohan.
So during the whole day today, we've talked about how there's scarcity of data. You don't really know what's happening there. I'm assuming for you, whoever is bringing the grant funding for you, your LPs, they must be looking for data beyond just financial profits. So what is it that you've put in your mandate, your thesis, but what is it that you're giving to them, or asking people like Puneet that this is what's happening there essentially?
So if you go to our website, we actually proudly tell people that we haven't seen any other venture capitalists doing what we do. Our portfolio on our website actually has each of the companies that we've invested in, and each of those companies actually provide us with information on a monthly basis that we actually provide not just to our LPs but for the world to see at large. Some of those metrics are very basic, but then we use market provided tools to convert those metrics into further metrics, like the number of trees that you would have actually had to plant to create the same kind of carbon dioxide savings impact, for example. So for example, we'll make an assumption in the case of Blue Smart. Let's say they've delivered 3 billion so let's say they delivered about 1 billion miles, electrical miles. What you could therefore hypothesize is that those billion electrical miles that have been delivered, if they had not been in existence, they would have been delivered on an ICE vehicle. And then what's really interesting is that the Niti Aayog in India, and similarly there is an organization in the United States called the EPA. And what the EPA does is it actually does a calculation for you. It provides you a metric that for every 1,000 kilometers or the equivalent thereof in miles, how much of carbon dioxide equivalent of savings you would have actually had. So then you can actually convert that, which we do on an Excel spreadsheet. We've got analysts who do that. And then we actually take that information and then we partner with a Dutch agency that actually converts the carbon dioxide into the number of trees that you would actually have to plant. So on a monthly basis for each company that we've invested in the mobility space, for example, we are able to kind of show our LPs that this was the measurable impact that the company would have actually had as a consequence of your investment in it. And then we provide that on a company basis. And then what we also do is on our main page, we actually aggregate those numbers across all of our portfolio companies and we provide them as one number. So you can actually go and see what that impact is on an individual company basis, and you can also go and look at it on what it is as a. So we can actually go out and say that our portfolio companies have provided so many tons of carbon dioxide savings. Our companies have actually saved so many tons of microplastics by not engaging in producing products with plastics and so on and so forth. And that's how we actually show our investors that we've done impact-led investing.
Is there a mandate on that? Like this is over the course of 8 years, this is what we need to.
Yeah. So for example, I'm not going to name the fund, but I can tell you that one of the largest climate funds in the United States, and it's a climate fund that actually mandates other investors to invest in climate. It doesn't invest in climate directly, but it manages a pool of capital that actually gives out to climate investors. And their mandate is that the companies that are being invested in by their investors that they actually give that capital to must actually sequester or save at least 50 gigatons of carbon over the next decade. And so by monitoring this, you're effectively proving to them that you've actually done that, right? Now, whether that actually happens or not, 10 years down the road, you don't know, but at least you have to show them that you're moving in that direction. And that's better than not showing it at all.
So we are out of time, we're over time in fact. So we have a reception where we can continue these conversations.
Happy to chat.
So I just like to thank the panelists
Thank you so much.
for being here and for you all for showing up on 3:30. Thank you. Thank you so much.